This year is all about financial education at Canopy Credit Union. We're releasing 20 videos in 2020 with ways to help you be more financially healthy this year. Sometimes being financially healthy is simply learning about different products and services so you know how to find the best deal for something when you need it. This week, we're talking all about home equity and when and how to use it. So what exactly is home equity? It's the difference between what your home is worth versus the amount that you currently owe on it. So for example, if your house is worth $230,000 and you still owe $180,000 on it, your equity would be $50,000. And locally, a lot of us have seen our home's value appreciate in the last couple years. As our community continues to flourish, our home values are going up, so you may be wondering, what's the best way to use that home equity if I need it? Many people use their home equity to finance larger purchases like paying for college, home improvement, or doing debt consolidation, because these loans have much lower interest rates than if you were to get a personal or an unsecured loan. Now, there are two different ways to access your home's equity, and which one you choose really depends on what you're hoping to use it for. The first option, number one, is a home equity line of credit, or HELOC for short, which allows you flexibility in your spending. A HELOC is kind of like an invisible credit card with a really low interest rate that is attached to your home's equity. As you pay it off or pay it down, your limit becomes available for you to use again. Your monthly payment is going to be based off of your current balance on your HELOC. A HELOC is your best option if you plan on needing to borrow again and again or use it for a longer period of time. It's also a great fit if you aren't sure exactly how much you may need to borrow. The other option is a home equity loan, which offers a lower rate than a HELOC and has a consistent monthly payment because you borrow a set dollar amount. So as you pay it off, the amount that you owe goes down, similar to a car loan, rather than having a limit that's available to you again and again. A home equity loan is a good fit if you have a one-time project or expense and you know exactly how much you need to borrow. Even though these loans have significantly lower rates, it can usually be about 1% lower than a HELOC, you'll start paying interest on the full balance of the loan the moment that you book it. So they don't offer quite as much flexibility as a HELOC does. Which route you choose to go really depends on what you intend to use your home equity for. What are you borrowing for? If you're still not sure, we'd be more than happy to provide you information and guidance for your individual situation. Give us a call or schedule an appointment online to get started. And as always, don't forget to follow us on social media, subscribe to our YouTube channel to be the first to see all our financial tips and tricks this year. Thanks for tuning in, and I look forward to seeing you next time.